Hello and welcome to the fourth chapter review for our online review program. So today we're going to be covering adjusting entries, financial statements, and the quality of earnings. So we have a couple of questions that we're going to be asking and answering today. The first is, what do we do at the end of the accounting period? What is the trial balance? And how do we build financial statements, and how are they all related? So let's get started. So we're going to first talk about adjusting entries. So we're going to review the accounting cycle really quickly. So the accounting cycle. So what we do during the period, so we start off, during the period, we analyze transactions. We then record journal entries in the general journal, so we just record all the entries of the transactions. And then we post them to the general ledger. And so this is, like T accounts. Then at the end of the period, right, so we start off, this is what we do during the year. Then at the end of the year, we prepare a trial balance, and we're going to get into what that is. So prepare a trial balance. We analyze the balances. We record and post adjustments, and then we prepare an adjusted trial balance. Then what we do is we prepare financial statements, and we then do our closing entries. So we close the books, and we're going to get into what that is, and we prepare a post-closing trial balance. And don't worry, we're going to explain what all of these different steps are. So first what we're going to do is we're going to talk about what the adjustments are, what the adjusting entries are. So adjusting entries are entries that we do at the end of the accounting period. It's very important. These are only done at the end of the period, and the purpose is to record all the revenues and expenses of that period. So it is possible, and I'm going to make a little timeline for you. So let's say this is January 1st of year 1. Then here's December 31st. And then here's the next year, right? So December 31st of year 2, December 31st of year 1. So here we have year 1, and here we have year 2. So it is possible, right, that we would have possibly an expense that would start in one period, right, and it would end in the other. And the purpose of doing our adjusting entries is at the very, very end of the year, we want to make sure that all the portion of the revenues or expenses earned in year 1 are going to stay in year 1. So we're going to record that portion then in the first year, and that's why we do our adjusting entries. And then in the second year, we would record the other portion. Essentially, the point of adjusting entries is we make that distinction at the end of the year so that every revenue, all the revenues and expenses of that period go into the correct period. So it's essentially to make sure under the accrual basis of accounting, and if you look at the previous review session, we discussed the cash versus accrual basis, we want to make sure that everything is in the correct period. So why do we need adjusting entries? As we said, cash receipts and disbursements do not necessarily match up with the earned revenues and incurred expenses, right? The cash does not necessarily equal when it was earned or incurred. So through adjusting entries, expenses are recorded when they are earned under the revenue principle, and expenses recorded match the revenue that they generate under the matching principle. Everything is put in the correct period. So there's many types of adjusting entries, but these are the main ones, and so they are deferred revenues and deferred expenses. So these are deferrals. And we have accrued revenues and accrued expense. So these are accruals. So under a deferral, cash happens before the event. Either the revenue is earned or the expense is incurred. Under an accrual, the event happens before cash. So a deferred revenue would mean that you receive cash before the revenue is earned, right? So you would debit cash, credit, unearned revenue. Under a deferred expense, an asset is acquired before the expense is incurred. For example, if you were to purchase rent for a year, so you have prepaid rent, and you would credit cash. An accrued revenue is where you've earned revenue before cash is received. So at the end of the year, right, you might debit, service revenue or sales revenue, and you have, you would credit service or sales revenue, and you would debit your receivables, so accounts receivable. So at the end of the year, you might make an entry to record the revenue you've earned even though you weren't paid yet. And accrued expenses. Expenses were incurred before cash was disbursed. So you might recognize, a utilities expense. And the classic example that's given for this that might make this a little bit more clear for you, let's say you have a cell phone and throughout the month you're talking on your phone, you're using Snapchat, you're using up data on your phone, and you're building up expenses, but you don't have to pay your phone bill until they send you the bill. But even though you haven't paid cash yet, every single Snapchat you send, you're using up data, so you're incurring expenses. So you would debit the expense and you would credit accounts or utilities payable, right? Or utilities payable. So the point is just at the end of each period, you're making sure that everything is put in the correct period. Another adjusting entry that we often see at the end of periods is depreciation. And you may have heard this term before. Very important to mention, this is a non-cash expense. Very, very important to mention. So what is depreciation? So the textbook defines it as the systematic and rational allocation of cost of a long-term asset over the time the asset is used to generate revenues. So if you recall, we said that a current expense or a current asset was one that you use within the next year. A non-current or long-term asset is one that you're going to have for more than a year. So, a long-term asset could be something like a truck or a building or equipment. And these are all expensive assets, right? These capital assets can cost a lot of money. They can be millions of dollars. But we're going to be using it for many, many years. A building can last 50 years or more. So if you recall, under the matching process, we want to match the expenses to the periods when they are earned. So depreciation is the allocation of the cost over many periods. So a $50 million asset should not be expensed in one period, but maybe we're gonna systematically depreciate it and allocate the cost over 20 years or 30 years. And there's an entire chapter on this, so we're not going to get too into detail, and you're going to learn about all the different depreciation methods. But the important thing to remember is that depreciation is not a cash expense. It allocates cost. So before we continue talking about depreciation, we need to define what is a contra account. So a contra account only exists to reduce or offset the primary account. And this is important because depreciation is a non-cash expense, and this will make sense to you. So when we are to record depreciation expense, we would debit depreciation expense. So this is an increase in our expenses, and we credit a contra account called accumulated depreciation. And this is a contra, that's what the X is for, asset. So it only exists to decrease that specific asset that is being depreciated. So the carrying amount of the asset, or its net book value, is going to be cost, right? So that's going to be equal to the amount that we paid for the asset. So it's the cost less accumulated depreciation. So it's going to be less accumulated depreciation. That's going to be however much that is. And that's going to give us the net book value. And we're going to go into further detail. We're going to show you what that looks like on the different financial statements. So if you recall, the journal entry is debit depreciation expense, credit accumulated depreciation, which is a contra asset. So the depreciation expense goes on our income statement, and the accumulated depreciation goes on our balance sheet, our statement of financial position. So under our income statement, under our operating expenses section, we would have our depreciation expense go there. And even though it is not a cash expense, it still decreases our net income. But what is very important to remember is on our statement of financial position, or our balance sheet, so this is going to be partial, of course. Let's say we had under our assets, we had a building that cost $100,000 less accumulated depreciation for the building. And we do not ever decrease the amount of the actual asset itself when we depreciate it. Rather, we add this to the contra asset. So let's say it had been depreciated for $10,000. That would give us the net amount of the building. The carrying amount, or the net book value, would be $90,000. And so over the life of the asset, the accumulated depreciation would increase and the book value would decrease, but we don't change the cost. We keep that at the amount that we paid for it. And of course, you don't need to be a pro at depreciation or anything like that. This is a post-midterm topic, but it's just important to understand how this works. So let's talk about our trial balance. So if you recall, in every journal entry, the amount of debits must equal the credits. Also, assets must stay in balance with liabilities and equity. So the trial balance is a list of all the accounts that we have and their balances, and it acts as a way to check that debits equal credits. So the entity will create an unadjusted trial balance before doing adjusting entries. So we add up all of our accounts, then we perform our adjusting entries, and we would use this to create our adjusted trial balance. So the adjusting entries, as you may recall, would be accruals like revenue, like we discussed, revenues, expenses, deferrals. We'd have depreciation. Income taxes isn't exactly an adjusting entry, but do your income taxes and your interest expense. And so you do all these, and that would give you your adjusted trial balance. All right, so we're going to now talk about our statement of changes in equity, how it's built, and we're also going to talk about how all of our financial statements are built. So if you recall, in the period, we have all of our journal entries, right? So we record our transactions. In journal entries, it's posted to the general journal, and then we post that to the general ledger, right? We create T accounts. And once we create these T accounts, we use that to build our statement of earnings. So if you recall, the basic formula for the statement of earnings is our revenues minus our expenses, and that gives us our net earnings, our profit for the period. Now, we use these net earnings to build our statement of changes in equity. So if you recall, the basic formula for the statement of changes in equity is our beginning retained earnings plus our net earnings for the period. So that actually we get from the statement of earnings. And then we subtract any dividends that were paid in the period, and that will give us our ending retained earnings. We then add that, right, with our beginning contributed capital plus any shares issued less repurchases of shares, and that gives us our ending contributed capital. So we add our retained earnings and our contributed capital, and that gives us our ending shareholders' equity. And we use this ending shareholders' equity in order to help us to calculate our statement of financial position. So our assets, if you remember, right, our assets are equal to our liabilities plus shareholders' equity. So that goes over there. So as you can see, they're all connected. One piece of one gives us the next step of the other. And finally, we have our statement of cash flows. And our statement of cash flows is our change in cash from operations, our change in cash from investing, and our change in cash from financing. And that gives us our net change in cash. So this net change in cash, actually, if you go here to your balance sheet, this can then be confirmed, and it should reconcile the change in cash from the beginning to end of cash. So it reconciles. It shows us how we actually got all that. So all the financial statements are connected. They're not created independently. Every single one ties into the other, and it's important to understand that this is part of an entire framework, and if you could understand how they're all connected, you can really understand the company a lot better. So now that we understand how they're all built, let's talk about the statement of changes in equity and what it actually looks like. So the first thing, as always, is we would put the title, right? So ABC Corp. Statement of changes in equity, and this would be for the month because it measures the change over a period. So for the month, the period, year, whatever the period of time is, it's over an extended period of time, and this would be, let's say, in dollars. So what we would do is we would have our contributed capital, our retained earnings. If it was for a public company following IFRS, you'd have accumulated other comprehensive income, and all of these together would give us our shareholders' equity. And so you would have, your beginning balance, right, at the beginning of the year. Then, issuance of shares. You would have your net earnings, dividends, and your ending balance. So let's just assume that this company did not have any accumulated other comprehensive income, but maybe they had $1,000 beginning contributed capital. They issued 500 more shares. So their ending balance for contributed capital is $1,500. Say it was a new company, so they had 0 retained earnings, and their profit from the year was another $1,000, and they paid out $300 of dividends, so $700. So actually, our total shareholders' equity would be $2,200. So this is what your statement of changes in equity would roughly look like, and you would add up at the end of each of the different categories. So this is basically what it would look like, and you're not usually asked to prepare one on the exam, but it's important to once again understand that equity is the result of changes over the year, either from issuing shares from our contributed capital, or it could be from accumulated profits less dividends, or for some companies that follow IFRS, it could be from your other comprehensive income. So let's discuss closing entries for the company. So what is the point of closing entries? So after we've created all of our financial statements, we do closing entries to transfer the balance from temporary accounts to retained earnings in order to zero out the temporary accounts. So what does that mean? Temporary accounts are accounts on the statement of earnings, and they are closed every year. Permanent accounts are accounts on the statement of financial position, and the balances are carried over from one period to the other. So what does that mean? On the statement of earnings, we are measuring the revenues and expenses of certain periods. In order to have meaningful information, it's important that we start off with a zero balance. If I was to come to you and tell you that my company earned $1 million in sales over the past 5 years, that doesn't really help you to understand what's happening with the company. Have our sales been $200,000 per year? Did we have 0 sales last year? In order to have meaningful financial information, it's important that we break up our statement of earnings from period to period, and that we start off with a zero balance. On the other hand, the statement of financial position, the balances carry over from one period to the other. So let me give you an example of the two on a personal level. If I come to you on December 31st and I say, how much cash do you have on you? You tell me, I have $100 cash on me. And let's say you don't spend that money, and the next day I come to you on January 1st and I say, how much cash do you have? Well, you still have that $100 in your pocket. But if I come to you on December 31st and I say, how much money did you earn this year? And you tell me, oh, I earned $30,000 this year. New Year's happens, the ball drops. January 1st, I come to you and I say, how much money did you earn this year? And you say, nothing. I haven't earned anything because it's a new year. You haven't started to work yet. So that's how it works with the statement of earnings and the statement of financial position. The statement of earnings starts with a new balance every year so that we can have actual meaning information and show what revenues and expenses were earned or incurred in that period. But under a permanent account on the statement of financial position, if you don't spend that money, you still have it in the next period. So the point of a closing entry is to close these temporary accounts on the statement of financial position. We want them to have a zero balance, and we do this by using a temporary account called the income summary, and it's only used at the end of the year to do closing entries. So we're going to get into that a bit. So there's 4 steps to doing closing entries. The first step is you close out your revenue accounts to income summary. So if normally a revenue account has an increase on a credit and a decrease on a debit, you would then debit all of your revenue accounts and you would credit income summary. The next step, is to close your expenses to income summary. So expense normally increases on a debit and decreases on a credit. So we would debit income summary, and we would credit each expense account. So it could be like depreciation, rent, and the list goes on. You would clear all of your expense accounts for the period. Then, once you have your income summary account, right? So all of our revenues went over here, all of our expenses went here, and actually your ending balance on your income summary should be equal to your net earnings, to your net income. So it's equal actually to your net income, and you can double check this with your income statement. It should equal. You close your income summary to the retained earnings account. And by doing this, we close all of our temporary accounts, all of our income statement accounts, and we move it to the balance sheet. And an easy way I find actually personally to do closing entries is to take your income statement and just start from the top. So you start from the top and work your way down the income statement, right? So you have your income statement, you have your revenues and your expenses, and you just go down that list, every single account, and you should hit every single one. You include stuff like income tax expense, etc. After you've closed your income summary to retain earnings, you're done with your income summary for the year or the period, and you then take your dividends out of retained earnings. So in case you haven't seen it thus far, you would debit when you declare a dividend, right? So to declare a dividend, the entry initially is dividends declared. So dividends declared would be debited, and assuming it wasn't paid right away, you would credit dividends payable. And this, whenever you decide to pay it, right, you would just reverse the entry and you will pay this eventually at a certain date. That's an increase in liabilities. But the dividends declared, this is what we're concerned about for our closing entries. So at the end of the year, right, so this dividends declared, we would debit retained earnings and we credit dividends declared. So we close out any dividends that were declared that year. So that is basically the 4 steps to do the closing entries. So the first one, close revenue to income summary. Step 2, close your expense to income summary. Step 3, close income summary to retained earnings. And then step 4, you take your dividends out of retained earnings. So remember these 4 steps and you will be safe. So we have a couple of ratios that we're going to cover today's chapter. And these are our net profit margin and our return on equity. And these are both ratios that measure our profitability. So for the net profit margin, we measure our net earnings over net sales. So if let's say we had $5,000 of revenue, of net earnings, and we had $20,000 of net sales, our net profit margin would be 25%. So this means for every $1 of sales, we have 25 cents of profit. So a higher number is better. We also have our return on equity, and this is our net earnings. So let's say our net earnings were $5,000 over our average shareholders' equity. So let's say we had, let's say we had $40,000 of equity. So this would be 0.125 or 12.5%. So for every $1 invested by our shareholders in the company, we have, let's say, 13 cents of profit. And like with our net profit margin, a higher number is better. And generally, companies with a higher return on equity will have a higher share price. It shows that your investment is being used well by the company. And as I mentioned every lesson, We're not going into depth about ratios. You have to read your textbook. You have to read more about the strengths of each ratio, the weaknesses, because they're not perfect, and they should be used to give you a general picture of the company. So we're now going to go to our buddies in Java Joe, and we are going to help them out. We are going to help them with closing their books, and we're also going to help Joe out by analyzing their net profit margin and their return on equity ratios, and we're going to discuss what this means for them. So the first step is we're going to do closing entries, and then we're going to do ratio analysis. So if you look here, I've actually got our income statement from the last review session, and we're just going to do our closing entries with all of our accounts right here. So step one is to close our revenue accounts to our income summary. So our sales revenue for the period was $24,000. So we're going to debit sales revenue, $24,000, and we're going to credit income summary by $24,000. Next, we close our expenses to our income summary. So we're going to debit income summary, and we're going to now add up all of our expense accounts. So the first one was our cost of goods sold, and that was $8,000. As you can see here, we then had our wages expense of $6,000. So wages expense, $6,000. We had our rent expense here of $2,000. So rent expense. We then have interest expense for the period. So interest expense is $400. And we have our income tax expense, which we cannot forget. So income tax expense of $1,520. So we're now going to add these guys up. And all of these add up to $17,920. So actually, if we look and we made a T account for our income summary, right? We had a credit of $24,000, and we had a debit of $17,920. And so if we were to subtract these two, this would give us an ending credit balance of $6,080. So if you look right here, that equals our net income for the period. And it should, and you can always double check that. It has to add up. The next step is to close our income summary out to retained earnings. So we debit income summary, and we credit our retained earnings. So we want to zero it out, so 6,080, 6,080. And there were no dividends paid out in this period. So that's our closing entries. So what we're going to do is we're going to actually calculate some ratios, and we're first just going to show what our equity is at the end of the period. So we're going to clear out our income statement here. And if you recall, right, so we're going to create our shareholders' equity section. So our contributed capital was $30,000, but now we have added to our retained earnings. Before, our retained earnings balance was zero because it was a new company, but because we have earned profit in this period and not paid it out to the shareholders of 6,080, we have total shareholders' equity of 36,080. And now we can actually calculate some of our ratios. So the two ratios that we said we were going to calculate was our net profit margin and our return on equity. So our sales revenue for the period were $24,000, and our net earnings, or our profit, were $6,080. So let's do our two ratios. So net profit margin. So So that's $6,080, right? Our net earnings over 24,000, which is our sales revenue. And so 6,080 divided by 24,000 gives us a net profit margin of 0.2533 or 25.33%. So what does this mean? For every $1 of sales that the company has, we have 25 cents of profit. We are now going to calculate our return on equity. So let's make some space. So our equity for the period, so we need our average equity, right? So our beginning equity was equal to 30,000, and our ending was equal to 36,080. So our average, right, so 30,000 plus 36,080 divided by 2 gives us an average of 33,040, right? Because our beginning was only equal to our contributed capital, but at the end of the period, we also had our retained earnings added to that, right? So this was our ending, but our beginning was only the contributed capital. So what we do for our return on equity ratio is we take our net profit and we divide that by 33,040, and that is going to be our return on equity. So 6,080 divided by 33,040 gives us 0.184. So 18.4% is our return on equity. So we can say for every $1 invested by shareholders, we have 18 cents of profit generated. And whether these are good or bad ratios, you have to compare it with competitors, with past performance. So JavaJoe doesn't have past performance, but we can use this as a benchmark to determine future quarters and determine when we were actually the most profitable. And we can compare this with, the local Starbucks, local Second Cup, or whatever other companies are available. As always, we hope to see you in the next review session, and best of luck.